Welcome to the Credit Clubhouse, where we take a weekly dive into the world of credit markets, alternative finance, and everything in between. Don't forget to follow the show, rate us, write a review, and share with friends. We're always open to guest or show ideas, so please feel free to reach out anytime. Just todd.anderson@dealcatalyst.io. I encourage you to check out the remainder of Deal Catalyst's 2026 calendar, including ABF 2026, Fund Finance West moving to Vegas for the first time, and GPLP Secondaries, which is a new addition to the schedule. Listeners can get up to 10% off any ticket to any conference by using the promo code CREDIT at checkout. And now, on to our next episode. This episode is brought to you by Cardo AI, the operating system for asset-based finance and private credit. These markets still run on spreadsheets and siloed systems. Cardo AI brings everything into one system: the data, the structuring, the borrowing bases and waterfalls, the cash flow modeling and simulations, and the investor reporting. That's front office to back office, all in one place. Today, more than 700 facilities and $150 billion run on Cardo AI. The world's most sophisticated investors and lenders use Cardo AI, equipping their teams with a level of control and intelligence that legacy tools simply cannot match. See it for yourself. Talk to the experts at cardoai.com. Welcome back to the latest episode of the Credit Clubhouse. As always, I'm your host, Todd Anderson, Head of Content and Programming at Deal Catalyst. Joining me today is Luke Chan, Head of Private Credit at HighVista Strategies. Luke, it's great to see you again. Thanks for coming on the show.
Great to see you, Todd. Thanks for having me on today.
So you've described, and in previous conversations we've had, collateral backed lending as kind of returning to that first principles of credit investing. What do you mean by that? And do you think the market, generally speaking, is starting to rediscover some of these fundamentals in the market today?
Yeah, absolutely. It's actually interesting. As a firm, HighVista focuses on specialty alts. And what that means is across our different verticals, we try to do something differentiated in order to generate substantial alpha for our clients. Oftentimes that means doing something that's very off the run or very niche or specialized. But in private credit, I think it's interesting because in many respects, what we do in private credit really does go back to first principles of what credit investing really is. And that's to say that private credit at the end of the day, despite all the different labels and different asset classes and types that are really in the asset class, it really corresponds to one thing. It really just means private loans. That's what ultimately private credit is. It's private lending, it's loans. And when you think about what a loan is, and obviously our audience here is very sophisticated, but it's worth just mentioning and bearing it in mind. A loan is really two things. It's a contractual return stream, your coupon, your fees, etc. And then on the other hand, it is your collateral, right? What am I, the lender, going to have security against to guarantee that the borrower is going to pay me back? I'm not going to assume the borrower wants to pay me back out of the good of their kindness of their heart. I have collateral. So in many respects, when we think about private credit, that's the lens that we use in our investing. And that leads us to more often than not, different kinds of collateral that we think we can be secured by on the one hand, and on the other hand, we can get attractive coupons and coupons that are higher than that which may be available in other forms of private credit.
So when you think about the lending opportunity, you obviously mentioned the collateral. How much, when it comes to underwriting, are you thinking the collateral itself, the borrower, obviously a combination of the two, but how much do you think comes down to the borrower versus the collateral?
Yeah, that's a great question. You're right. Both of those really matter. You can't really lend to a bad borrower. You can't lend to a borrower that is dishonest, right? Now, there may be borrowers that are well-meaning, but they get into an unfortunate situation. Their business plans don't work out. The macro cycle turns on them, whatever it might be. And in that case, as a lender, You're not necessarily focusing on the borrower writing the ship on their own. You want to be focused on having collateral that you can hang your hat on. And so in that respect, I think what we do is really focusing on that collateral. The borrower is relevant, it's contextually important, but it's really the collateral that we focus on. Um, and tying it back to what I mentioned earlier, I think that's what differentiates us from a lot of maybe traditional private credit, particularly direct lending, where it's effectively one form of collateral, corporate EBITDA, corporate earnings. We're really focused on a variety of different things.
And how do you think about kind of the durability of that collateral? Because obviously everything looks good in good times, but good times don't always last forever.
Yes, absolutely. And that's something that naturally I think folks are thinking a lot about today in 2026. There's a lot of different types of collateral out there. There's a lot of physical collateral that I think folks can have an intuitive sense of what that might be worth under different macroeconomic scenarios. For instance, real estate. I think everybody is familiar with real estate. You live in real estate, you work in real estate, you have a good sense of what that might be worth. You know that the value of that can fluctuate, but you probably can underwrite what's the value of that real estate under different conditions.
Yep.
Other hard assets are equally applicable. You can probably underwrite other hard assets or real assets, such as natural resources, natural resource assets. You could probably underwrite things like equipment and machinery or inventory. Those are all forms of tangible assets, um, tangible collateral, but there's also forms of intangible collateral that are nonetheless valuable. You could think about things like receivables, royalty streams, loan portfolios, maybe NAV that a borrower might have. Those are all forms of collateral that really can be subject to the same underwriting that you can kind of analyze anything else.
So if we look at, a particular asset class that obviously has gotten a lot of attention, the last few years in particular, this, from the start of this year, and that's AI software.
Yeah.
And as that, kind of AI infrastructure spending accelerates, which seemingly is at a pretty breakneck pace, how do you think lenders should think about kind of durability of the revenues from software, enterprise customer stickiness? What do you think about kind of some of the dynamics taking place in AI and software right now?
Yes, absolutely. I think software, software is such a good example of why the focus on collateral really matters, right? Because at the end of the day, what is the collateral you have in a software borrower? Maybe it's recurring revenues, maybe it's enterprise value. That's really the question that a lot of lenders who have lent to software companies are now asking themselves. Um, I think it's worth really spinning through some of the fundamentals as to why AI is impacting software. I think by now, folks are familiar with the fact that AI might be a threat to software.
Yep.
But it's worth describing exactly what those threats are. And so I think to do that, it's worth kind of taking a step back and really describing why software has become such a large portion of the economy and of investment portfolios. Many measures show that software, for instance, could be 20 to 30% of your traditional direct lending portfolio of the leverage loan markets, for instance. So how did it get there? Well, the first thing is I think software is a very special business. It's a business that has a few unique characteristics. One is that the capital cycle in software is very favorable. You invest a bunch of capex, R&D dollars, maybe venture funded dollars up front to build a software stack. But once you've built that, you're making incremental improvements. The capital intensity for R&D can go down.
Yeah.
On the other hand, your customers are extremely profitable. They're profitable because you have extremely high gross margins. That is extremely important. One is, you have these 90%, 90 plus percent gross margins in software, in SaaS software, which is extremely unique. In every other traditional business, you have cost of goods sold, whether you're manufacturing widgets, whether you're serving food at a restaurant. In software, it's almost like you just hit F9, boom. You can fulfill another customer with that software because it is all digital. And then likewise, those customers are very sticky. So you sign a customer up, they're going to be a subscriber for years and years to come. They have a strong lifetime value. And that justifies a lot of upfront spending for things like customer acquisition and sales. But once you've scaled that platform, you can potentially have extremely high operating leverage and very high mature financial margins. Again, enabled by that fact that you have high gross margins, high recurring revenue, and you have sort of front-loaded CapEx. And so that's very attractive for software, for equity investors, for the economy. That's why it's taken such a large share of capital markets and of investment portfolios. And then from a lender perspective, traditionally software has had a very special feature, which is you can toggle off or reduce costs significantly if you need to. Now, as I told you before, you might be spending a lot on your sales force in order to win new clients, customers. But once you've won them, they're basically going to be sticking around for years and years to come. That means that if you need to boost your free cash flow, you can easily reduce costs, right? You can reduce your sales and marketing spend. You can reduce some of your R&D spend incrementally, and that can turn you from what might be a lower margin state to a very high margin state. And that's good for the owners of the software firms, but it's also very attractive for lenders, right? Because the lenders know, hey, these guys might not have a lot of free cash flow now, but if they really needed to, they could boost their free cash flow profile and we would be money good, right? And so through that, a lot of lenders have gotten comfortable. Instead of lending against debt to EBITDA, they've made a transformation where they will lend a multiple of recurring revenue or a multiple of revenue. And the logic there is that lending against revenue is something that we can do because that revenue multiple can translate into some kind of EBITDA multiple if I'm in a scenario where I have to increase my operating margins or my EBITDA margins. And then, of course, the industry has traded on ARR multiples for the past few years, and so that's become the predominant yardstick through which these types of borrowers, are measured. So that's what the game used to be. Now, enter AI. What does AI do and how does that impact software? If you go back to those three things that I mentioned that make software businesses special, they have that front-loaded CapEx, they have high gross margins, they have very strong lifetime value of customers, sticky customers. AI directly threatens all three of those factors, right? It's obvious, for each of them when I explain it, but when I think about the CapEx, you might have a great software platform today, but with the advent of AI, whatever capabilities you have in your platform, they're not going to be good enough for your customers in the upcoming years. Your customers are going to expect that, you're going to offer AI-enabled capabilities. You might offer agentic capabilities. Whatever that is that your customers are going to expect, you're going to reinvest. You're going to need to reinvest a lot of CapEx or R&D dollars to get there. And so that's a drain on capital. The second problem is the gross margin problem. As I think folks know, AI isn't free, right? When you're using AI, you're going to be using a lot of tokens. You're going to be using a lot of inference. That has a cost. Most directly, that's the cost of power that you're consuming when you're using AI. That will have a tendency to reduce your gross margins. So instead of being able to just hit F9, okay, I've spooled up another instance on Amazon Web Services to offer my software to this new client. Now, if that client is using your service, you need to be paying for power. And that's going to reduce your gross margin, and it's going to make software businesses more similar to every other business in the economy, which is they have some kind of cost of goods sold. But that's a downside risk financially. And then the third element, which is the lifetime value, I think that is also threatened for general software companies as well, because now the customers might be switching. They might be switching because a new competitor has popped up, right? A new competitor that has been coded, that has been developed, that now is better than your platform. They might be switching because they want to move to something that is purely agentic, as opposed to users working through some kind of user interface to interact with the software. That's a threat. And then, of course, AI itself might make it easier to switch from one software provider to another software provider. Traditionally, a lot of software has been very sticky because it's been such a pain to switch, but maybe AI helps with that. So all three of those factors are really simultaneously threatened by AI. And of course, other industries are threatened by AI in different ways, but I think software is unique in that all three of those factors, are being attacked at the same time. Now, where this all comes together is that we're at a point of very high uncertainty in the software sector. You've obviously seen that in terms of trading levels of equity and debt in software. there's no doubt in my mind that some of these companies will be able to succeed over the long term. They're going to be able to pivot and innovate their platforms to be AI native. They'll be able to manage a transition, let's say, from seat-based pricing to usage-based pricing. And through that, they'll be able to gain market share and be very successful. But I think that there's also an understanding that not all of those companies will be successful. Many of those companies will not be successful. And the problem that lenders have vis-a-vis equity holders is that lenders don't like volatility.
Yep.
If you have a portfolio of 100 software companies and half of them double and half of them go to zero, the equity collectively might be fine, but lenders collectively will lose because you can only make so much on your loans, but you can lose 100%. So you don't like volatility as a lender. And this is important, and shouldn't be overlooked. All of the things that I mentioned, if you're a software company and you want to compete and you want to be able to get to the next level to be a winner, that takes capital. It takes resources and focus. In credit markets, particularly the credit markets we're talking about, levered credits, resources are in short supply because these software companies are heavily indebted, right? They've borrowed, and this is where things come full circle. They haven't borrowed even a multiple of EBITDA. They may have borrowed a multiple of their ARR, their recurring revenue. They might not even have any EBITDA. Now they're stuck in a point where they have to service all of this debt when they really want to be using the capital to be reinvesting and innovating in their platforms. And that's what's creating a huge threat for software in particular.
Do you think we're entering kind of a new phase of what valuations and capital structures for software are going to look like? Or is it kind of just normalizing from an overheated cycle that we've seen the last few years? Like, or is this third, maybe the third piece is it's a bit unknown given all those things you just walked through with what AI is doing and can potentially do.
Yes, absolutely. First of all, you know, a lot is unknown, right? I think I'll be the first
Yeah.
to admit that certainly I don't have a crystal ball. I don't think anybody does. When we think about software companies vis-a-vis lenders, I think you can make an argument that things were overheated. And I think by overheated, it's really a question of valuation. Were valuations too high relative to where they are today or relative to where they might be in the future? Certainly, that's what the public markets are saying
Hmm.
in terms of things that are traded, both equity and credit. But I think the broader question is, your point number one, which is there going to be a structural shift in how lenders interact with software companies? And I think the answer is yes. I can't see how the answer could be anything but yes, because fundamentally, um, you know, it goes to my point. You have to lend against some kind of collateral that you can liquidate, right? You've got to be able to say, I'm making this loan to the borrower. They have their business plan. But if they don't achieve their business plan, either because of something they did wrong or because of something that happened exogenously, I'm going to be protected as a lender. I'd be taking that much downside risk.
Yeah.
And so what does that mean for software, right? Software companies don't have tangible assets, but they do have valuable assets. They do have that ARR, as I mentioned, right? And so one framework you could use is, listen, as a lender, you know, I don't really care if the borrower is able to innovate. It's secondary to me whether the borrower innovates and succeeds. The primary goal is to kind of get paid back. So if I need to, have I lent a low enough amount where if that borrower with a revenue profile that might be declining switches into a high margin loan mode, can I cash flow myself down? Right. And so that seems like something that could make sense as a regime. Recently, though, I think leverage levels for software borrowers have been well in excess of where you could simply cash flow it out over a reasonable period of time. You really had to assume that those borrowers either could refinance you out or that they could sell based on a multiple of ARR regime that tends to be, 3, 4, 5 or more time multiples of their ARR, which is, I think today for software companies that are struggling, it's going to be challenging to get that kind of exit.
The other piece to obviously the software and the AI is digital infrastructure. And obviously the CapEx needed for a lot of projects on the digital infrastructure side is quite massive and seemingly can overwhelm traditional lenders. Where are some of the kind of biggest financing gaps you're starting to see emerge today in the digi infra space, which is obviously helping to power this new AI revolution or whatever we want to call it?
Yeah. Listen, I think AI revolution's a perfectly fine phrase. The flip side of everything we've been talking about with software is, of course, AI. It's worth talking about that. What are the opportunities for lenders in that market? Um, I think one thing's for sure, at least for now, we don't know where this will end up. We don't know if it's a bubble. We don't know what the ultimate value add to the economy will be. Um, but the demand for AI right now clearly outstrips supply. It is the tools are extremely powerful. They use a lot of power. I think they have the potential to be value added. I mean, we're using them now at HighVista, and they're adding a lot of value to our investment processes and otherwise. But the demand outstrips supply, and as a result of that, there's a lot of investment going into building out the infrastructure to deliver AI. That infrastructure includes power, of course. It
Yep.
includes data centers. It includes semiconductors. It includes everything that connects all of that together and actually delivers it to the user. Um, and given that the demand is so high, it seems to have no limit. It almost seems as if the demand for capital also has no limit. And in fact, the numbers that we're seeing that are being invested into AI, into data center builds, for instance, continues to increase. And now it's was measured in the billions and tens of billions. Now it's measured in the hundreds of billions per year. It's may go into the $1 trillion figure per year. Um,
Yep.
the volume of capital that's needed is so high that I think there's just naturally going to be a limit to what capital markets can supply, to what financiers can supply. I mean, we've seen that most recently with Google the other day. They've actually had to issue equity in order to finance some of their data center and AI ambitions. That's shocking. This is a company
Wow.
that has been one of the most free cash flow generative companies ever. It has a very strong fortress balance sheet, but they've basically consumed their free cash flow. They've consumed, um, you know, their debt capacity at least at the margin, given their regime, and they're actually now moving to issue equity. If you had asked me 3 years ago, will Google be issuing equity? I would say no. There's only one thing they're going to be doing with their equity, which is buying it back. But here we go. They're issuing equity. And then, of course, there's a huge amount of demand for equity on the part of the various AI companies in the ecosystem, public and private. There's an availability of capital there, but that probably at some point runs into limits. On the debt side, we're really seeing debt used to finance the physical infrastructure of AI. We're seeing that being used to finance, for instance, data center construction. We're seeing that being used to finance the purchase of GPUs, for instance. And so far, that market has been reasonably organized. And the reason for that is because the backstop, or it's thought to be that the backstop for a lot of these development projects are very creditworthy investment grade counterparties, right? We're
Yeah.
talking about hyperscalers like Google, like Amazon, Microsoft, those types of companies with very strong credit ratings backstopping effectively this capex. And so far, the debt markets, whether we're talking about ABS markets, whether we're talking about bank lenders or private credit lenders, have been very willing to lend to finance those ambitions. But I think even that has limits. And we're seeing now with some of these gigawatt sort of data centers where the capex need for a single data center, you know, they can reach really astronomical numbers. $10+ billion needed for a single data center. We're finding now that sort of the private credit markets from the part of banks, let's say, so not really private credit, but the bank sort of project finance market is really showing signs of strain, where there's
Yeah.
just too much supply of these loans, and the traditional financiers can't hold all of it at this particular time. We're seeing some of those loans which price pretty tightly, anywhere from plus 250 to plus 400, somewhere in that range. We're seeing some of those really be offered on the secondary market at substantial discounts, which I think indicates that that market, at least for now, whether it's just tactically or cyclically, it has been sort of oversaturated. Now, I'll be interested to see, the market might take a pause, maybe capital will form again, or maybe that demand will just continue to grow and it will cause problems in other financing markets. But again, it's not because of any kind of fundamental credit deterioration, which is typically what you see. The
Yeah.
reason why we're seeing this is just because the amount of demand is so big. And we haven't seen that kind of demand explosion, I think. I can't think of another example.
So if we shift a little bit to more specialized and asset based lending. Obviously, that's also one of the more interesting themes, moving beyond just your traditional direct lending, and some of the conversation we just had around AI and digital infrastructure. Well, what sectors are kind of you most excited about in some of these other areas of maybe niche or maybe off the run asset types?
Yeah. Yes, absolutely. Um, I think there's a lot of different, there's naturally a lot of different kinds of collateral in the market. You can think about basically any asset that exists in the economy could be a form of collateral. What we're trying to do is really focus on what we consider to be the handful or so of most attractive collateral types at any given point in the cycle. As you can imagine, the relative attractiveness of a certain form of collateral will really vary based on market conditions, right? It's obviously going to be a combination of what are the coupons and spreads that we can obtain on the one hand, and on the other hand, what is the LTV? What are the covenants? What are the different protections that we can obtain, in order to protect our downside? Some of the areas that we're really active in today that I think are, um, you know, not really not directly related to software and AI, but maybe have some sort of either downstream or upstream impact is we're very active in natural resources. We think that natural resources is a wonderful form of collateral. We're talking about things like oil and gas wells. We're talking about things like renewable power. Those are clearly related to the topics that I mentioned, and there's a very positive outlook for demand there. So we're active there. In terms of another area that we're active in that I think will be relevant to a lot of listeners of this podcast is going to be sort of GP assets or fund assets. So we're active in lending really in things like NAV or GP finance, things of that nature, and those are obviously refer to different kinds of collateral depending what the underlying assets are. But that's a relatively new market that we think really has a lot of room to run in terms of innovation. And if we can be at the forefront of that, I think we can get access to attractive forms of collateral and downside protection while earning spreads. And then we're also, we are active in more sort of off the run areas. And so, we have traditionally been involved with things like financing legal assets, legal related assets. Some call it litigation finance. And as you can imagine, that's going to be kind of far afield, be subject to less competition. And obviously, if we can get the right underwriting and sourcing and structuring, then, could be quite attractive. And so we find those are three of the areas. We have 6 or 7 that we consider to be attractive at any given time, but sort of illustrates for you sort of the types of areas that we're looking at.
When you're looking at some of these new areas, is there any particular characteristics that it's like, hey, this may be an area that could be interesting to go into, or we see this opportunity here because of this, not necessarily giving away the secret sauce, but like what makes you
Yeah.
think, hey, this could be an opportunity?
Yeah, I think the two questions that I would ask, and I would suggest that every lender ask is, one is this a collateral type that I could underwrite, right? Is this something that if I spent time trying to understand that industry, that I could figure it out? And so, a lot of these things are going to take effort relative to whatever lender's already been doing. Imagine if you're switching from EBITDA-based lending to real estate lending. You're going to have to learn, figure out how real estate works, but you probably could figure it out. So that's the first question. And then the second question that is what we find to be extremely helpful is more of a contextual question, which is what are the dynamics, the lender dynamics and the borrower dynamics in that particular market? And we tend to really favor collateral types or sub-markets where it's either very specialized and therefore there's not a lot of competition. And if there is competition, it really competes at a higher cost of capital, right? So the cost of capital is natively higher because it's such a specialized area. So that's one positive fact pattern. The other that's related is it might be an area that is competitive or normally well served by lenders, but it's been temporarily dislocated, right? So something has happened where the lenders have really pulled back, or there's been a surge of borrowing, perhaps, where that the supply demand of capital is all out of whack. And both of those things that I mentioned really serve to increase the cost of capital and improve terms for lenders. So that's what I would focus on. Likewise, if that is going away, right? So an example of the former might be in software, right? We talked a bit about that. Terms in software are probably changing, and so it's something that
Yeah.
lenders should watch, and will watch it. Hey, if coupons go up, if LTVs go down, at some point it becomes really attractive for us and other lenders to step in and really provide more capital. On the other hand, if we're doing something like lending against a form of real estate that was dislocated, and then competition has really heated up, and maybe interest rates come down and banks are getting more aggressive, therefore spreads are going down, LTVs are going up, and collateral protections and covenants are weakening, that may be a sign to step back.
What areas or what about private credit do you think is still misunderstood or underappreciated by the LP?
Yeah, I'm talking about the general LP here.
Yeah.
Obviously, there's I, I I would hope that many of our listeners would agree with this, but there's a lot of concerns about private credit. There's a lot of headlines. In general, I think they tend to be more alarmist than they need to be. And by that, what I really mean is if you're investing in private credit, and you're doing it the right way, you know, or even if you're just doing it in a general sense, you're investing in direct lending. At the end of the day, these are senior loans, right? So you have a diversified portfolio of first lien senior loans. Yes, over the past few years, spreads have compressed. But when you think about the downside, you've got senior loans, you've got significant equity cushions, you have diversification. And so fundamentally, your downside shouldn't be that bad. And so, sure, in your traditional unitranche senior loan, maybe you're getting something like an 8 or 10% contractual return from your coupon and fees. In a downside case across a portfolio, that might look like 5 or 6%. That's the downside case, right? And so that's not that bad. But if you read the news articles, you would think, oh, I'm going to lose half my money investing in private credit. No, I don't
Yeah.
think so. Yeah, I mean, yes, if you lever your private credit portfolio up, if you back levered at 3x, if you're focused on second lien loans to software companies, then yes, you may lose half your money. But if you're just a general private credit investor, you're an allocator that's investing in private credit across a multi-asset portfolio, the private credit area is one that does have downside risk, but the downside risk is relatively modest and it's still a positive return relative to other asset classes. Because if you think about the whole chain logically, if I have a private credit portfolio and a material number of those loans are defaulting, a material number of those loans are losing money and not recovering par, right, which is what would have to happen in order for you to even go from a 10% contractual yield on your portfolio to only actually achieving a 5% IRR or something like that. What does that imply for the equity? What does that imply for the sponsors? What does that imply for the borrowers? I think if you think about it logically, if you're concerned about private credit, economically or from a macro perspective, then, I think you should be asking other questions about your portfolio. And those questions will probably lead you to being a bit more sanguine about your allocation to private credit.
Couple of other forward-looking questions before we have a few fun questions and wrap up. If we're sitting here in 3, 4 years, what do you think's the biggest change that happens to the private credit landscape? Is it AI? Is it something else?
Well, I could answer that well, there's a lot of different ways to think about it, but I guess in keeping in line with what we were just talking about, I think, let's say over the next 3 years, you go through the macro cycle, right? That we're overdue for some kind of downturn. I don't know if it's going to happen this year, next year. Let's say over the next 3 years that does happen. I think you're probably going to see a bunch of things reset. I think you probably see terms for lenders improve, spreads improve, things like that, covenant quality increase at the margin. I think you probably see, there's been a lot of talk about retail assets flowing into private credit. I think that's what's causing a lot of the headlines,
Yeah.
probably less relevant for institutional investors, but I think a lot of that becomes more tempered. And I think this is against a backdrop of retail investors overall across the board getting introduced to and getting educated about alts, not just private credit, but also private equity and the other alternative asset classes that they now have access to. So I think that becomes more tempered and hopefully matures. But overall, I think the AUM, the total assets available, continues to grow. So I think it's going to be, we're not going to see a huge structural change. Private credit isn't going to melt down. It's not going to cause any kind of systemic risk. At the margin, you're probably going to have terms adjust in reaction to how credit conditions change. But overall, I
Yeah.
think you'll continue to see growth, and you'll see growth across your institutional investor landscape. You'll see growth from retail and high net worth. You'll see growth from your insurance providers as well. That would be my expectation. And then I think where the action is really going to happen is going to be in these and across these different collateral types, right? So in the aggregate, I think private credit is here to stay. But whether you want to invest in this collateral or that collateral, I think that's really where the game is played.
And then final question before some fun ones. I mean, what's one of the biggest lessons that you could take from kind of, I guess, this first evolution of private credit over the last 10, 15 years? Seems like we're entering a different phase of the space, but is there anything from, kind of the last decade or so that, you'd say is the biggest
Yeah.
lesson or maybe a few lessons?
Yeah, absolutely. First of all, as we've been alluding to here, private credit is subject to the capital market cycle. It ebbs and flows in terms of conditions. But I think what's interesting is that, when you look at private credit, it really has grown over the past 15 years. And really the 10 years is really where you've seen the bulk of that growth. And so while the industry is mature in many ways, I also think it's nascent in many ways. And there's going to be a lot of new areas of private credit that will continue to develop. I mentioned some of them in
Yep.
our discussion here, but I think it'll be pretty interesting for investors and lenders to watch. Okay, what are the new areas where we can, at the end of the day, make loans, right? What are the areas where we can find collateral, we can lend money, earn attractive coupons, but at the same time have collateral that we can hang our hat on? I think that is going to be something that I very much look forward to observing over the coming years.
So a few fun questions as we wrap up here.
Sure.
Favorite sports team and or hobby?
Sports team. So, I live in Boston, so naturally a Boston fan. I'm, with the finals going on here, unfortunately, my Celtics aren't in there, but I guess I don't have a dog in the fight, at least as far as basketball is concerned. But yeah, favorite sports team would be Celtics, and then nationally I'll be rooting for the national team in the World Cup here.
One surprising thing about yourself.
Surprising thing, one of the things that I've been doing over the past couple of years that I think has been pretty helpful is I've been doing extended fasting. Once or twice a year, really going a few days without eating, only limiting myself to water. I find that it helps to clear my head. I find that it helps to kind of build maybe psychological fortitude. It's something that I would recommend folks do if they haven't given it a shot.
Interesting. One book you'd recommend reading.
So I'll give a little bit of a, maybe off-piste answer here. Given what we've described, and we're talking about AI, instead of recommending a book, what I would recommend, our listeners do is really ask AI to write them or produce an in-depth report about something they want to learn about. Whether it's about something related to your job, like, how LMEs work, or whether it's something just, that you're interested in, like gardening, ask it to do it. I think you'll be surprised at the quality of output that it can produce, and it probably will rival a lot of books that you might, borrow or buy on the subject.
Most exciting part of your job.
Most exciting part. So as I mentioned, really like seeing when sort of new collateral areas or new areas of the markets develop. Closer to home here in terms of, managing a team at HighVista. One of the things that I find very exciting is when one of my team members really spends a lot of time on a project or an analysis or a new area of collateral, and then they really figure out how it works. And you can see that light bulb go on, and they can present a lot of things to you that teach you a lot of new things. I really like seeing that and being educated by my team.
And then final question. I know we talked about kind of lessons. I mean, what the private credit market might look like in the next few years, but what's one prediction for the next 12 months?
Prediction over the next 12 months. Very easy one. I think software loan prices will continue to go down. We haven't done a lot of that lending or have been much of a participant at all, but I think we're watching those numbers drop by the day. I predict that we'll probably start getting involved once those trading levels hit where we'll get excited.
Well, I think that's a good place to leave it, Luke. Thank you very much. Really appreciate your time, and continued success to you and the team at HighVista.
Thank you very much, Todd. This was a lot of fun. Really appreciate you having me on.
Of course, thank you. Thank you for listening to the Credit Clubhouse podcast. Credit Clubhouse is brought to you by Deal Catalyst, the leading capital markets events and market intelligence company. For more information on Deal Catalyst events, surveys, and a whole lot more, please head to www.dealcatalyst.io. Thanks for listening. Until next time.